Yeah, well, I'm going to pick up on your thread of it enabling technology because in 2000, probably 2 years ago, so what is that now, 2020, maybe late 2019, um, a few of my former banking colleagues just throughout the industry were asking us about property insurance, which, I used to just say buy as much as you possibly can, and the client would come back with as much as I needed, and it was kind of a check the box. And I got on a call with about a dozen lenders, and the themes were, A, we don't really understand insurance, but B, our clients are now saying they can't procure what we expect, and most of them are in technical default with their loan contracts, which is never a good spot to be. So we're signing waivers. And it's inhibiting the ability for us to do deals because it's moved from the bottom, check the box, up to now like a top 3 risk.
Yeah.
And if you have a deal in Texas that can't get insurance, we're not going to finance it and you're not going to build it, basically.
Yeah.
So it moved from a check the box way up the priority stack to the point where it could actually inhibit deals. And at the time, we were not active in property insurance, but we took our same data-driven model. We added a whole lot of historic loss data into our database. So we actually have about 50 billion worth of assets where we know the loss history, we know the events that occurred, we know which ones led to losses and which ones didn't. And are using that to enter the property space because what happened in renewables, the broker in our market, Sarah, who I have to attribute this to, but she called it a correcting market embedded in a hardening market. So, so we all know that the property market in general has hardened. I mean, all of insurance has kind of hardened over the few years. But there was a seminal event that if anyone knows anything about renewable energy insurance, was a big hailstorm in 2019 that led to about an $80 million loss in Texas. And the theme is generally the market was pricing to grow and pricing to historic losses, and the risk profile of the underlying asset was changing. And, honestly, the nature of cat events were changing. And it kind of caught the industry blind, kind of caught us by surprise. And, that was followed the next year by some localized fires on site. So there've been pretty material, I'll call them extreme event type losses that have really forced our market to correct while the entire market's hardening. So we saw rates increase. We saw the guy who runs my property division, he calls it the Nat Cat fundamentals, but percent of TIV deductibles and sublimits for cat and things that probably should have been in our market previously. But it's really added stress into the project finance landscape because project finance lenders don't understand insurance. I would say insurance doesn't really understand project finance for the most part. We bridge that gap because we come out of both worlds. But now you're in a situation where the bank hasn't underwritten Nat Cat. They don't know what AIR or RMS is. They've never heard of a PML until last year. These are not concepts that they deal with on a regular basis. But they're saying, you're telling me if there's a hailstorm, the project has to take the first $10 million of loss because your deductible's big. So let's use our project finance tools to solve that. So we put in a big reserve, or we push that risk to the asset owner, or they do something to kind of push around that risk. But it's really been a challenge, I'd say, for our space within this kind of climate insurance space. Because generally the data historically has been poor. The models are not very well tuned for this asset class. And people have lost money. So, we're taking a different lens on it to say, okay, we know the data, we can calibrate the models, we can use our market knowledge and our data to, I kind of call it the hard data, which is like we physically go in and we change the models or tune the occupancy codes to match what we see happening in the field. And then the soft data to say, okay, we go to solar asset management conferences, we know this OEM fails at low wind speeds, we know these clips are bad, and we can kind of know how to snip off the tail. Because ultimately, if you can avoid the worst pool of projects, that's driving all of the losses in our segment, and outperform the market. And I'd say even go one step further than that, which is give feedback to our clients or the people submitting applications about what they can do to make their project more resilient. I'd say in all of this, that's one positive element, is because insurance isn't just writing off the risk. The risk has been pushed back to the owner, and a lot of innovation has happened to make projects more resilient.
Yeah.
Like, if they're holding the bag for the first loss, they're going to get creative about ways to avoid that loss. And that's kind of that data co-op model that we play. So we can give them feedback and say, hey, we've heard this other party over here has a hail mitigation program, and here's how it looks, and have you guys considered that? And you should hear some details about it. Because in our space, like, no one wins if, I mean, it's a very competitive market, but no one wins if their competitor's system gets destroyed by a hailstorm. Hi, I'm Jason Kaminsky, the CEO of kWh Analytics, and this is the future of insurance.